When you get a text from Triple D at 10:30 at night talking about the markets, it's usually not a good thing. Hawkish Fed, weak earnings season, rising inflation. Do we need any more problems? Like in the banking system? We got a lot to cover today. We'll talk about it with Jeremy Schwartz, too, from WisdomTree, folks. This is one show you're not going to want to miss. Roll the intro, Mitch.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your hosts, Joel Elkanin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I'd buy that stock for a penny.
With everything you need to start your trading day.
All right, let's look at the damage here on this Thursday morning. S&P's down 11 3/4 handles, giving back that little rally we had at the end of the day. We're at 39.8275, trading just off the lows of the session. The dollar, that's down 22 cents at 105.03. Bonds slipping too. They're down 21.30 seconds and 124 and 22.30 seconds. Crude trying to find a home and support at the $76 area. I got three lows in the last 5 days there. Up 4 cents, 76.70. Gold hovering over the low of the move, 220, up 220, 18.20, 70. Silver still in the 20 handle, down a couple pennies, 20.12. Rush Band and Bitcoin futures. They're down $500 at 21,615. Let's bring in, undoubtedly, the hardest working man on Wall Street. Oh!
That's Mitch. Mitch works way harder than I do. There's absolutely no doubt about it. Mitch is everywhere. He's running shows, running Benzinga. He's live trading like a champion. He's everywhere there. So there's no doubt who works harder here. Who gets more like caught up in like little like
we didn't even plan that one, team.
Gets,
we
like,
didn't even
going
plan
down the whole rabbit hole. That's me. I go down the rabbit hole. I went down the rabbit hole last night, something fierce, Joel. And I got full on like sitting in bed thinking, oh my gosh, are we going into financial crisis part 2?
What?
but I don't think it's going to be that. But I can see a path where what the Fed has done here is create problems for the banks. Because naturally you think, oh, raising interest rates has got to be good for the banks. But you guys have been pointing it out for a while here. Besides JP Morgan, let's forget about them for a second because they're best of breed. Jamie Dimon obviously went through, problems before, and he's just created a monster bank that is very well run, the most well-run bank. But look at some of the others, and we're going to go to the regionals in a second. But let's start with the big guns. Look at Bank of America, almost back down to the lows. Citigroup's been holding up fairly well, but we know Citigroup, from the where it's been, and Wells Fargo starting to go off here now. Morgan Stanley holding up pretty well. Goldman Sachs really not holding up great, back down near the lows of the move again. But a whole different tale. You could say the big banks, some of them are weaker. None of them look really great, though. But then you go to the regionals, and you think, what is going on? Yeah. Regions Financial, straight down for 2 days. You can go into KRE, which obviously covers them all. That's been a little bit of the Silvergate, which we're going to get into in a second. But it's in other issues as well. These regional banks, the charts just don't look good. So there's 3 banks that have an issue here today, and we're going to call Silvergate Capital a bank, at least for another few days until it sounds like it's winding down its operations here.
It's just Silvergate.
For a few more days, we'll call it a bank. So give us the news here. We'll start with Silvergate because that's what everybody's talking about here today. Start with SI.
All right, this is one that at least we have been waving the red flag on this one for a long time now, especially since November 18th, Kathy buy. But Silvergate Capital said it would shut down its operation in light of recent industry regulatory developments. Silvergate believes that an orderly wind down of the bank's operation and voluntary liquidation of the bank is the best path forward, said the company in a statement.
Yeah, never good. Winding down their banking operations here. And Silvergate Capital down 42%.
Cool.
Again, bankrupt stocks don't necessarily go right to zero. Stocks winding down their operations don't necessarily go to zero, but they don't usually rally either unless the memesters get a hold of it. Who knows? All I'm saying is this is not good news. We know this is related to the crypto. We know this is related to a whole pile of other problems there, which are very well publicized, which have been talked about in the media for a long time. Signature Bank, SBNY, related to a certain extent because they obviously have not the same operations, but they have crypto operations here, Signature Bank. They're down 9% in sympathy here. So obviously worries, about their, crypto operations or cryptocurrencies there, because I'm just looking, at the numbers there too, $8 to $10 billion worth of cryptocurrencies tied in. And so they have exposure here as well. So they're worried about SBNY as well due to their crypto exposures here. And
I want to give a shout out too. I want to give a shout out to the Bear Cave. I don't know if you guys have ever heard of Edwin Dorsey, the Bear Cave. He mentioned this SBNY and their exposure.
Yeah.
And he was expecting
that you mentioned. I thought I remember that a while ago.
Downside action with SI, and he was like, I don't know how this one's hanging in there right now. And they're definitely going after
these charts look terrible. I mean, now it's down 9%. You're talking about SBNY at the beginning of 2022 is $350. It's $94 here now. These stocks are in free fall here. So that's the ones that everybody's going to be talking about, the major media, because of the SI, winding down the operations, SBNY. Similar, but not obviously as maybe, as in as much trouble as Silvergate, but still in some trouble here. But then flying under the radar, really until today, was SVB Financial, which is SIV Bank, which is Silicon Valley Bank, which is down 28% here right now.
What do they focus on?
Right.
Well, what do they focus on, Dennis, before we get to the story? What is it that SIV Financial Group focuses on?
Venture capital. So they have a lot, obviously, Silicon Valley. So they're lending to startups. They're lending venture capital. They're aggressive lender. And that's why, and times get tough here, things can change quickly. So I went down the rabbit hole. First, they did an offering last night. And you can show, if you want, the Benzinga Pro here, the headline from last night. Typical offering, knocked the stock down 4 or 5%. So I'm pretty used to this. I haven't been following the story at all until last night. And the reason I started following it last night was I saw the offering and I was like, that's usually, 4 or 5% will knock it down. And if you show it's a double, they did the mandatory convertible preferred plus, they're doing equity. So they're raising some cash, but you don't usually see a stock fall 28% on an offering. So when it's just started going to free fall, I was like, what is the backstory here? I'm like, what is going on here? Because this does not seem typical for an equity offering. So then you start doing some research and you're like, oh, this is a very aggressive lender. And then I stumbled across this Twitter account, which you might show now here, Mitch, on your screen.
I got you.
At Raging Ventures. And I started following them last night, Raging Capital Ventures. And they had a tweet, 10 tweets back from January the 18th talking about this bank. And this was fascinating reading this. And I don't know if this is accurate. I don't know at Raging Ventures. I was just, reading and trying to research why is the stock down 28%. And this is from January 18th. So they were way ahead of this. But they were talking about Silicon Valley Bank ahead of their earnings. And after that, the stock actually kept going up for the next 3 weeks before now we've seen the implosion. But they were talking about their large exposure to, one, the stressed venture world, which we obviously just mentioned. But they were talking about deeper problems here. So if you go down, I'll just read you some of the stuff. They're talking about they rode the VC boom like a champ. That's when the stock's going up, because VC was booming. And we know VC's had a really rough time. So it's not surprising that this bank has had a rough time too. But they're saying there's bigger problems here. And the bigger problems isn't so much their venture capital, their VC lending, but it's actually their HTM, which is held to maturity securities portfolio, because it's full of mortgage holdings, long-term mortgage holdings. So they're saying, and again, just as I'm scrolling down here, their agency mortgage holdings went from 13.5 billion at Q4 19 to 99 billion at Q4 21. So basically, and I'm just reading the tweets right from this. Again, I have not verified any of this information. I'm just reading right from this. But if any of this is true, this is really scary stuff. The bank basically increased its security portfolio by 700% at a generational top in the bond market, buying 88 billion of mostly 10 plus year mortgages with an average yield of 1.63%, Joel.
Oh, Jesus.
Sounds fabulous.
So this is like, what?
1.63.
1.63. You got $88 billion of 10 plus year mortgages yielding you 1.63% in an environment where we just went 5.2 on the 2 year. I'm like, holy crap. I'm like, this is a bad book. So they're arguing, again, this is Raging Ventures is arguing that if they had to mark these mark-to-market losses on this book, that this bank is actually functionally, and they're saying functionally underwater if it was liquidated today. I mean, this is just scary stuff. So then you start thinking and you're like, are there more banks that are just, and again, in the US, we know a lot of US mortgage, that have mortgages, people who have their homes and have mortgages, have long 30-year mortgages. Well, who's on the other side of all those? Is it the same banks with aggressive lendings? I mean, 1.63% is super low. I don't even know how that's possible. But, in my personal situation, I have a rental and I have a fixed mortgage, which has 2 more years on it. And I've had that at 1.64% through Bank of Nova Scotia. I'm like, that thing, I slowed the payments. And I call my banker, I slow the payments down, amortize that thing as far out as it can go, and slow the payments down to nothing. Because it's like free money for me. I'm like literally borrowing at 1.64 and I can turn around and invest at 5.2. I'm literally picking up that much from the bank. There's no doubt who's losing that money. It is the bank that lent me that money. And now they've got 5.2, that they're paying me on that thing. I wish I had, longer on that. But those are assets now for the consumer, but they're liabilities for the banks. So you start thinking and you're like, is there other banks? And maybe, when I was talking about this amortization conversation, and we're taking it back to the Canadian banks for a second, when, we got Joe Investor or Joe, Joe Consumer Spender going into the bank and saying, hey, my mortgage payment was $2,000 a month. Now it's $3,000 a month. What can you do for me? Oh, we'll just extend your amortization from 25 years to 40 years. We'll bring your payment back down to $2,000 a month. Well, that helps the consumer out. But maybe the banks aren't doing that just to be nice. Maybe they're doing that because they don't want the houses. They're doing it a little bit out of necessity because the interest rates went up so much here. They're like, wow, so even on the variable ones here, these aren't actually assets at a certain point in time if the consumer can't make the payments. So there's a lot to think about and a lot to chew on here. The one thing that will keep us out of a financial crisis, I'm not saying we're going into a financial crisis, but I'm saying there's a path there. The one thing that will keep us out is that the Fed can fix all this very quickly by just pivoting and, lowering rates. So if we get into a situation where we have smaller banks starting to fail because they have really crappy long-term mortgage books, the Fed will have no choice but to start, helping out by bringing interest rates back down. So lots to chew on here.
Hasn't the damage already been done?
The damage has been significantly done for some of these. And the SIVB, the damage is current right now. The stock is down 27% here. But it gets you thinking, like, why are the regional banks so weak? And I'm like, well, maybe they all got really crappy long-term books. So maybe we can't just be worried that SVB is full of crappy venture capital loans. Yeah. Maybe they're full of, mortgages that are actually just not paying very much. And if that's the case, maybe there's other banks that are in the same precarious situation. So this is scary. So all I'm saying is I wouldn't want to be investing in the regional banks here right now, even though KRE is coming into major support here. I'm concerned. And full disclosure, I'm short KBE, not KRE. So full disclosure, I do have just an overnight trading position in some of these, which I will trade out of today. So, but just saying that there's concern here for, just throwing blindly and saying, yeah, let's just jump in. These regional banks are really coming down. Dig deeper. Make sure they're not full of really crappy long-term mortgages.
All right.
The thing with just to stay on this for 1 second, it was that key bank yesterday, and I have no idea what assets they have or lack of assets, but a bank giving lower guidance. I couldn't put my finger on it. I'm like, what is going on?
Yeah.
And they ended up, I mean, Key ended up holding up okay. They started hitting some of the other banks.
Yeah.
But this is something that that we really didn't need, and we just have to see how it spills over. But the Fed is not going to turn around and build. I mean, they're not going to pivot on something like this. This is longer term problem. I got SIVB. I'm not even going to try and give support in this one. SI, and then what's the other one that's related to it, Dennis?
SBNY.
Okay,
And that's more on the SI.
Signature
So
Bank.
SIVB is its own problems. It's not
Yes.
related to the whole situation
Got
with
it.
SI and SIVB. Some people would think that because they're all down huge today. But
Yeah,
SBNY and SI are related. Similar. SI is obviously done, that they're going to wind down the operations. So that's why it's down significantly there. SBNY has some crypto exposure as well. So they're worried about that one too. And then SIVB is a whole different can of worms, which we just went through.
I can give you some names at least in regional banks that we went through on start swing trade.
Yeah.
So some of them that don't look that great. PNC, one of those. This chart to me just looks like somebody wants to get short on that one. We'll look to see if that one breaks through kind of the 140.
These look terrible.
Yeah, look, this is our monthly
It's
support.
flying under the radar because we're so caught up. And Mitch, this is such a fantastic point to make. We're so caught up in Apples and the Teslas and the Nvidias and the tech stocks. And a lot of these don't have debt too. Like Tesla is a different story. But I mean, there's a lot of, that don't, and Apple can service their debt. But I mean, we're so caught up in, tech focused and the media as well. We talk 90% about tech stocks because they're fun to talk about. But this is sliding totally under the radar. This problem, like look at this PNC chart you're bringing up. 165. It just lost 20 points here in the last month.
Monthly support.
Right down to the support. We're right down near the lows. Like we're near the October lows here, Joel. I mean, these are not healthy looking charts. And then you start analyzing what we just did here and you think, are these banks that are lending all this? Like who's on the other side of all these mortgages? That's what I want to know. There's got to be some banks. I mean, if you're holding a 30-year mortgage at 3.5%, the person who is on the other side of your mortgage is underwater in that. There's no doubt because it's 5.2%. It's just the rate right now on a 2-year. So you're underwater in that. So, and in my case, like I said, I have a 1.64. I did a 4-year 1.64 fixed about a year and a half ago on my rental property. And I mean, I can invest at 5.2. I'm literally just making money off
arbitrage.
What's that?
Arbitrage.
Yeah, I know. And that's why I called my bank. Somebody's asking, can you just go through it again? Yeah, when I realized, I'm like, holy, this is a great asset that I have right now, borrowing money at 1.64. I called my banker. I said, amortize that thing as far out as you can go so I can slow my payments down to a crawl. I don't want to pay off any principal. I'd like to pay zero. But, you can't do that right now because it's only 1.64%. I'm like, I'm going to hold that as long as I possibly can. Now, again, I only have like 20 months left on it. So in 20 months, when it goes back up, I'll probably just pay the damn thing off because I have the money to do it. But that's a different story. I mean, right now it's like, awesome. That's an asset. Well, there's other people that have those same assets out there. And it's if your fixed mortgage is 3.5% or 4% or less, it's an asset. And that's a liability to these banks. And I think you're seeing in the trading action here, I think you're seeing that show up in some of the trading action in some of these regionals.
I had a similar one, and for years and years and years, and just kept rolling it over. And I don't know. I think it was maybe like 2-3 years ago. They're like, no, we're not offering that anymore, and so it wasn't available. But I looked at the PNC. You're looking at this 144 area where we're trading at right now. That's been support since January and February of 2021. Trading below it right now. Co-America, not as heavily traded a bank that is at a double bottom that theoretically has supported 66. The KRE that covers it all, right? That's just had a horrible couple days. That even went down before the key bank. That went down with the market on Monday. So, are there any other ones that fall into this category?
Yeah, I got you. You know, I'm all about
Mitch.
that
Let's
relationship. You ready? I'm gonna rip through these, and you guys just make quick comments.
And show
PNC, we started. TFC is the next one. Truist Financial Corporation.
TSC.
TFC. Frank. TF.
Okay.
Then you got MTB, MNT Bank Corp. This one dropping fast. Looks like that 140 stands out to me. Then FITB, that's Fifth Third Bank Corp. And they all look kind of similar. Very ugly looking
Heavy.
charts. And
Yeah.
then one more to just bring
problematic.
one in, Regions Financial Bank. This one's near actually the top. This one actually looks a little bit better to me to come after it now. But RF, Region Financial.
Starting to fall the last 2 days, though.
Yeah, that's a big move.
Yeah,
That's a
I
big
mean,
move.
And
usually
there's
the
plenty
banks
more,
are
of course.
slower. And naturally, your thought process still is, rising interest rate environment is good for the banks because you're charging your customers more interest, but not when you're all tied up. Not when you have that mismatched maturity problem. And that's the issue is really what we're talking about is mismatched maturity. I mean, most of their deposits are short term, and if their book's long term, you're tied up in a long term book at 3.5 or less, and you're paying out 5% to get deposits. Well, that's not good math. So, I mean, not all of the banks are going to be in this situation. I do believe the regionals are more, obviously you get the big ones. There's so much more involved in other things. That's why we're picking on the regionals here, because mortgages are a bigger proportion, at least. And I'm not, again, a banker. But to my understanding, regionals are more involved in mortgages proportionally than probably some of your majors are. Majors still have lots of mortgages as well, but there's so many other businesses that can potentially, help with that. If you've got, mortgage books that suck, we got all these other, investment banking businesses and all the other things helping out. So regional banks may not be in the same situation. So yeah, and you look at the KRE components here, SVB Financial number one, just jumping, and looking at all, there's just so many regional banks. I mean, this is very interesting to say the least, and doesn't make me feel like, look at this one, FRC, First Republic, Joel. Here's another one. I'm just going through the charts. None of these look good. Zion Bank, right near the lows.
What's that, ZB?
Zebra ION.
Okay.
Just going through them. CFR looks kind of heavy here. Again, I'm just picking from the KRE here, so I'm some of these are going to obviously be heavier mortgage lenders than others.
Is IAT. It's a ETF. It's a regional bank ETF.
What is it?
That's iShares Regional Bank ETF. IAT.
IAT, yeah.
So just to kind of bring it, and you'll see how this looks
these
exactly
all
like
together.
a lot of these regional
pick your
banks.
poison. If you want to be bearish on and let's go look at options. I mean, maybe there's certain times where you can be an option buyer, and it's when the market isn't pricing in the risk enough. So sometimes it's like, I get shorted, or maybe the options aren't crazy here. Let's go look KRE, for instance, and maybe they are crazy, but we'll just go out, look at the KRE. So it's trading at $57. If we go out, you got to give yourself enough time if you're making these calls. Don't go to like the weeklies. Go out to June. See what the June is. 55 puts, $1.70. It's not crazy expensive. It's not great, but it's not crazy expensive here either.
I think we need an update in the market.
Yeah, an update in the market to put some of these strategies on.
You know how it is, right, Dennis? That would help, right?
That would help.
Nice little update in the market. Bring that.
I don't feel
down
great though, Mitch, about and especially when you were independently, kind of looking at charts from a technical, and you're mostly a technician, and you're looking and seeing the same thing, and then you get the fundamentals that are backing up what you're seeing technically, and you kind of got your ducks in a row here, and you're like, these regional banks, you need a bounce here, but man, I don't think I want to own any of these things.
Yeah, and I think now I just play a little bit of leader laggard, right? The leaders that have already broken down for 5-6 days. Well, I'm not going to be able to probably catch up to those trades, but I can catch up to the ones that are just starting to fall. So I'm going to keep an eye out. How will maybe the regional banks slowly start trickling into the global banks? Do you think that will happen, Dennis? Where if the regional banks keep coming and getting hit, they go after the global banks?
I think so. I think it's a scary adventure here to be going in the banks right now. So just don't go blindly thinking, well, who benefits from higher rates? It's the banks. Let's own the banks, because the mismatched maturities throws a whole wrench into that. So I think I'd be cautious right now. I would not want to buy any banks at all. But you just wonder if this isn't all just flying under the radar because we're so caught up just in tech stocks and the fun. And I mean, everybody's talking about Tesla. I mean, CNBC hasn't even mentioned any of this stuff we're talking about. Nothing. Not nothing. Maybe Silvergate. But they're, I don't even know if the SIV, because it's down 28%, will eventually get a mention. But I've had it on the background here. I haven't seen it mentioned yet. So, I mean, there's a lot of things to think
They
about
need to
here.
watch our show first and get some content.
Well, that's what they do. Yeah, they do that. We know that. We had that confirmed from, we do know that. Jason Raznick confirmed that. So that they watch our show and do borrow content. But we watch their show and borrow content too.
Hey,
so this is how it works.
I
watch
hidden
all the time. I borrow content.
Yeah, exactly. There's nothing hidden
share
out
content.
here.
We share content.
Information's information. It's how you use it that matters, right?
That's it.
Yeah. So one thing just to note,
we lose Joel.
I've been for a second. He'll be right back. He'll turn his camera on in a second. Now, one bank that I have been seeing starting to come down fast is Bank of America, and it doesn't look like the best chart. Also, you guys can see this kind of declining wedge. This looks like we've come up here multiple times to the resistance, rejected 38s. Now we reject 36, right back down towards the lows. So we start breaking, let's say, through the 30s. Where does Bank of America stop from there? Next stop is around like 27.50s, but I mean, this doesn't look great. And of course, will Goldman Sachs hang on to that 340s? It looks like it's coming right back down to break those 340s. So I'm keeping an eye on that one. JPM just started breaking a trend line here around the 140 levels. So I'm going to be looking if JPM could get back to that 140 level. I don't mind risking off of like 143 for a short, as long as it could bounce a little bit here. It's already coming down to 136.61s in the pre-market. Yesterday's low was 136.87. We'll look to see what happens to these global banks. But yeah, it's an interesting play, Dennis. These have been really strong for so long. I mean, we could look at like XLF, right? The financials, you have seen how this has had a nice little January, but slowly starting to break, right? This 36 here on XLF, that looks like major resistance to me. I mean, yeah, we've gone up there slightly, but I mean, just slightly, right?
Yeah. I have the pair trade on right now. And again, I'm going to take this out. This is an overnight trade. So just full disclosure, I'm long XLF, short KBE, because I was of the opinion that the regionals are going to have a rough day today here. And the majors won't have nearly as rough of a day, but that's just the trade. But again, I'm going to get out of that. So full disclosure, but just talking, positionally, I don't have anything on here, but you start thinking like, man, there could be some problems here, some problems under the hood here for some of these banks. And that's why you're seeing this new weakness here in the banks.
And then as we get that weakness and we get the worry, will we finally find out about worrying about like a firm? And Upstart, right? Those types of companies have been just lending and lending and lending.
Well, I
really feel like these will be a part of a disaster, part of the story, right? I mean, we've been looking at this. My only question is, do we really get into worrying, like to the concern time? And let's go back to the
830 number here, Mitch.
Yeah, let's get to it. Here comes the jobless numbers. So we're going to pay attention. I'll give you guys the estimate here. Estimate is 195, prior 190. Let's see if we keep going on what the lower end of that initial jobless claim. So like, let's say if we get a 180 something number, that's not going to be good. A higher job claim number could be good for the market, as you're starting to see finally unemployment get a little bit of a spike. Let's find out here. 829. We're about to get also continuous jobless claims. So pay attention to that. We'll see what happens there.
Lots to chew on here. We'll get in the comments. Let's do the 830 number, and then we'll continue this conversation here. I know we got some individual stocks to talk to. Etsy down significantly on a double downgrade here. Also, American Express did a buyback. So there's some interesting individual stories. But let's get this 830 number. We are very wide here right now. We are rallying.
Wide.
We're rallying up here again. I still
rally. Okay,
shop fest. I'm still calling choppy waters ahead here.
It is. Coming up on our mid-range on the session right here as we head into the number. So far, ignoring this bank news, let me get the S&P 500 index futures here up. Let's see. We're in the 39.90 handle.
Got the number here. Initial jobless claims coming in at 211,000 versus 195,000 estimate. That is good for the bull story. Finally getting initial jobless claims to start heading in the right direction. Continuous jobless claims also coming in hot. 1.718 thousand versus 1.659 thousand. Prior was 1.655. That should be in the millions. I don't know why they put the thousands there, but 1.718 million. Jobless claims getting a little bit of a spike. that's actually a good outlook, right? That's what we kind of
It's
need
okay.
for
I mean,
eventually
that's what we want. The big
Yeah.
numbers tomorrow. I mean,
Mhm.
that's the big number. This is a good indication here, perhaps for that number tomorrow. So we're just hanging in this area, boy. What another! I said yesterday was an important day for the market. I think today's too. People don't want to lean too long into that report tomorrow, and think about taking some chips off the table. What a reset, and what a choppy day yesterday too. Right at
Yeah.
the end of the session, we're going to close on the lows, and they bring it right back up. When he's when Powell's testifying, man, you just like hands off the keyboards. I mean, that's just very hard. But special programming note, folks. The reason I stepped away for a second is I tried to see if I could get Nate Tolbick on the
Nate would be
complete
good,
bank data report.
Yeah.
And his immediate response is, you know what's going on with the banks right now? I am so busy, but I'm going to do a special bank report today at 11:30 on PreMarketPrep.com, and we're going to bring Nate on, get his let him assess the situation.
Yeah.
I also reached out to our good old buddy who we haven't talked to in years, and his phone number got changed, Tim Melvin. Wouldn't you love
Tim
to
would be
hear from
good,
Tim
too.
Melvin on this?
Yeah,
and,
Tim would be
our
good.
banking expert. So I don't know if I'm going to be able to get him at 11:30, but you go to premarketprep.com and you'd be there at 11:30, and you'll get some more information on the what the bank contagion or possibility. But market's acting okay. We're almost back at unchanged here, unchanged on the session. That comes in at 39.95.
Evan
Banks
making a
not
comment.
participating here much, though. Think about that. Just we're just had this conversation here, obviously, but banks have come up a little bit here, but we're still, even though the S&Ps are red, I'm just looking at the banks across the board. They're all, or the S&Ps just went green. The banks are still holding heavy red here. So there's obviously, they see what's happening with certain banks here today, and it's concerning.
A comment in the chat that I just wanted to note there. They were like, it's weird to hear Mitch say that he wants high employment. Well, the truth is that that's what we're going to need right now. If you really want the Fed to pivot, you need kind of high unemployment. And that's what's going to need to happen. Is it a positive thing? Not really. I mean, you guys heard all the politics yesterday and all that meeting, but the truth is we're going to have to break demand. And a lot of that is first breaking the labor market, and then you could pivot, right? Then if we get unemployment to spike, let's say up above that 4%, yeah, we'll start seeing.
Yeah, Todd Gordon was talking about that on the closing print. He's like, he had his finger on like the put hedge button yesterday, and he said he's just so convinced that he's keeping a close eye on that too. But once again, if you're out there buying the dip in the markets today, you're being rewarded.
I think if we get a good rip today, I'm going to lighten up the portfolio, a long-term portfolio, even further, because I think there's more issues here than meets the eye. So this research, we're getting a nice rally here now. This is more of a gift, in my opinion. We get back up into that 400 SPY. I think I'm going to take some more chips off the table because I think we have more problems here than anybody's catching on to.
Sell the rips.
Yeah, I'm always selling the rips, but I'm more convicted on the sell the rip here today.
All right, let's go to some micro news.
SPY.
Let's
another
go to
10. Give us another 10 handles. That'd be nice.
Yeah, I mean, if we get back in the 400,
I don't think
we'll
you're
see.
gonna get it.
I don't know if we're going to get it either, but I'm hoping.
Let's go to BJ Wholesale Club. They reported their earnings here. Q4 adjusted EPS at $1, beat the 87-cent estimate. Sales at $4.93 billion, beat the $4.8 billion estimate. BJ Wholesale comparable club sales grew 9.8% year over year. And then when you take a look at their fiscal year 23 comparable sales growth outlook, it's at 4 to 5% year over year. Membership fee income to grow 5% to 6%, and EPS to remain flat year over year. BJ's has been doing really, really well. I think we keep getting good mentions from Walmart, Sam's Club. That keeps me to think that, yeah, BJ's can keep kicking it out the water.
Again, this is, defensive, people buying, people going in bulk. I mean, this is just the type of stock that continues to work in this environment. We talked about this I feel like we were talking about this last week when it was dipping. Weren't we talking about this one? That I thought we mentioned BJ.
Yeah, we were
But-
going through it with maybe Costco.
Yeah, I
Costco's
think so.
report,
I mean, this
and-
is one that just continues to work. So
Sure.
even in a recessionary environment, it's a stock that holds up better here. So major resistance up at 80, but I wouldn't just automatically fade this.
77.60. That's your last print. Your pre-market high came in just above 79. Dennis has alluded to this beautiful double top that you had just above 80. Those pair of highs were 80.30 and 80.41. I see one other sneaky high though ahead of it that I'd keep an
Sneaky
eye on
highs.
if I was long the stock. 79.38 was your November 16th high.
All right, let's go to the next stock here that had earnings. Let's go to Asana, somebody's favorite stock. I remember someone talking about it, guess. Q4 EPS loss of 15 cents beat the loss of 27-cent estimate. Sales of 150.23 million beat the 145.07 million estimate. They do see Q1 revenue to 151 million versus 149.97 million estimate. Q1 EPS to a loss of 18 cents and a loss of 19 cents versus a loss of 23-cent estimate. It's not making money, but I mean, I guess some people still like the Asana story. I'm not really a fan. I'll tell you that.
And it's come off the highs. It just got absolutely insane last night. And again, this may be short squeeze, whatever it was. These earnings weren't great. They initially hit it on the earnings, and then they just squeezed the hell out of everyone. And they brought this to $24 last night. When the circus is in town, Joel, you're on mute. When the circus is in town, you've got to sell those peanuts. The circus was in town. The elephants were, balancing on balls, and you throwing peanuts in the air and grabbing them and everything. Sell those peanuts, folks. Sell those peanuts when the circus is in town. Absolutely stupid rally last night up to 24. It's already back down to 20.
Right over 24. And if you were quick on your looking at your dailies, you would have said 24.47. That was an October 22nd high. I bet you we didn't quite get there. We got to 24.36. So, and now you're leaking. I mean, now you also have people that are caught in this rally. Now, what's the top of yesterday's range? I don't know if we're going to see that, but maybe a longer term if you want to get to this thing. Maybe look at the $18 area. 18.11 and 18.18 were the highs from the last two sessions. And you know who we haven't talked about in a while? Dustin Moskovitz. He's the CEO. He just kept. Mitch, can you pull up how much stock this guy's bought in the last just put it in pro?
Yeah.
And that was the
insane
thing last
amount.
night. He wanted to buy more. He put a filing in to buy more. I mean, this person buys their stock. They believe in their company. There's no insider buys. It seems like it's nonstop. It was always
it seems like he's maybe taking a little bit of a break because we haven't mentioned it lately.
He has taken a little bit of a break, but it's kind of funny that you guys bring this up because I actually was I was talking to someone that works at Benzinga, and they were asking me, Mitch, what do you think about insider buys, right? What do you think about them? Do you think that they have like an edge and stuff like that? I was like, well, I think sometimes they can have an edge if it's like a massive buy, right? But a lot of the times it could be a moment like this where Asana, where this guy's been building and building and building a position. You can see every time there's director here on the right-hand side, anything that's short, that's him buying there. But you guys can see massive amount of buying there in Asana, but that doesn't mean that the stock's going up, right? And I think that that's another thing to keep in mind. So for me, insider buys aren't the biggest edge there. I don't know. What do you guys think about insider buys?
Well, it depends. I mean, sometimes they get lifts on them, but this has had so many insider buys that people have become almost numb to how much he was buying of the stock. I mean, you love to see insiders buy that give their own stock a vote of confidence. I love to see when a CEO comes in and is willing to buy their own shares. But I mean, we had Aubrey McClendon, remember, on Chesapeake that just kept, he went so hard in, he was borrowing money to buy his stock. And that didn't help it at the end. I mean, it ran into problems, and, he lost a pile of his money for obviously had the car crash and he died tragically. But I mean, he lost a pile of his money investing in his own company. So I love the vote of confidence there. Obviously, the CEO is a completely different situation too. The CEO is really rich, is he not? the backstory here.
Yeah.
On the
Oh,
CMF.
I mean, he was rich. I'm not sure.
I think he's buying. I don't know. So, but I mean, I'm a lot more
Oh,
money than
man.
your average CEO. So,
Yeah,
lots
yeah.
to think about. Lots to chew on here.
Another rally here. Just
Yeah,
99.50.
we want 400 SPY.
Yeah.
That's what I'm going at. 400 SPY today.
Pushing
I'm gonna
back,
dump more
pushing back.
shares.
Joel, fix the mic. Fix the mic. I need to fix the mic cue. We need a little signal for it. All right, let's get now. I'm going to get out of this. Let's go ahead and out of the sauna. Let's get to our guest today. Smash the like button. Let's keep it going right here. Pre-market prep. Jeremy Schwartz, Chief Investment Officer at WisdomTree. Welcome back on, Jeremy.
Good to see you, Mitch, Joel, Dennis. Great to be with you.
All right, let's get right towards the market. How do you react first about all what's going on, different situations in the banks, but we'll do a little mix. Silvergate Capital, SIVB. What do you think about the situation that's going on right now?
The headlines, unfortunately, it's so much about the Fed. Like, we can't avoid the narrative. You got, Powell testifying and the market's taking all the cues from the interest rates. Obviously, the crypto scenario has its own set of situations and with Silvergate there, but the market itself, like it started popping a bit as the rates started trending down after this. The weekly jobless claims came out, and so it's all about the Fed. Tomorrow's a big day. It's actually arguably more important than the inflation report coming next week, even though some of the I saw some people tweeting about how volatility estimates for this Friday versus next Tuesday, versus the inflation next Tuesday was higher for the inflation than the jobs report. But the jobs report is arguably now the key thing for Powell on how much tightening has to do, how much wage pressures are there. They're taking their cues from that as where is there still inflation in the system. So jobs Friday, critical number, and even just a little, it's another strange dynamic of weakness is good for the market. It's because they view the Fed pivot is coming. Now, what's holding the market up this year is we don't have the recession that jobs have been holding in. The economy's not slowing down. Earnings can come in better than the real bears fear, that because we just haven't seen the economic impact yet. So we've got this strange dynamic in the markets here.
Jeremy, we were talking before we came on the show, and I'm not sure how much you were listening, but we were talking about interesting situation, not so much with Silvergate, because everybody knows kind of the story there. But we're moving into this other big down move of the day, which is SVB Financial. I don't know if you follow this bank or if you follow it closely, but down 29% here today. And I was just digging up last night and looking at, some of their problems lie in the fact that they've got a mortgage book that's over 10 years extended out, and some of these mortgages yielding downwards of 1.62, 1.63%. So mixed match maturity issues here. Just want to bring this to a bigger issue. Is there the potential, Jeremy, you think that there's more, like we automatically think that higher interest rates are good for banks. But when you get mismatched maturities where you get the short term and the inverted, I mean, this necessarily isn't always good for banks. And is there the possibility that some of these regional lenders maybe be sitting on a lot of ugly long-term mortgages, and obviously in a rising interest rate environment, that isn't really the best place to be?
One of the inverted yield curve is also not helpful for them, right? Because it's raising some of the short-term costs of borrowing, and on the longer end, are they getting as much from new loans? And some of it comes back to, people who have the debt, like a lot of people refinance at extremely low rates, and there's not, in a way, it's been a real net benefit to a lot of people who have mortgages at low rates and who are now collecting a lot more interest income because Treasury is yielding so much more. So we had a conversation with Warren Mosler on my podcast, and Mosler's on one of the guys who's challenging orthodoxy that these higher rates are restricting the economy. He says higher rates are stimulating the economy because people are earning so much more income. Very regressively are earning much more interest income. And you haven't seen the flow of refinancings hurt people yet. I don't know a lot about Silicon Valley Bank, so it's hard for me to talk the details on
Yeah,
the specific issue.
just
But
talking in general.
it's you wouldn't be surprised to see more downturns in housing prices. Now, the question is, how does the today balance sheet of banks compare to the financial crisis? During the financial crisis, a lot of the banks held all these securities that they thought were rated AAA that ended up becoming rated much less, and then they became much more risk averse. So I think bank balance sheets are in a lot better shape than they used to be.
Yeah.
And so I want to look into the details of this one to see what particularly is triggering losses. Is it a mark to market in some ways with higher rates, or is it just that they think there's going to be a lot more losses and people defaulting? What was there a detail on what's causing the loss?
Well, again, this was just SIVB situation is interesting because it was just a capital raise last night. And this is what, I started researching late last night, because I wasn't following the story closely. And you think, oh, capital raise, they knock 4 or 5% off the price. And then they start knocking it down 15, 20%. You're like, what's going on here? So then you start digging deeper. And, obviously this is Silicon Valley, so they have a lot of venture capital. So there's bad loans out there, I'm sure. But, some research just looking was that, they've got a really bad mortgage book where they've got, some long-term mortgages with 10 plus years on them at very low yields. And this inverted curve is definitely not helping them. So I'm just thinking, like, and take it away from this bank. I'm like, this, my own personal situation I was talking about, Jeremy, is I've got a rental property, and I'm in Ontario, and they do typically 5-year fixed here. I'm in like the third year of a 5-year fixed at 1.63%. So I called up my banker about 3-4 months ago and said, extend that amortization out as far as you possibly can, because this is free money for me. I'm literally just what you were just talking about. I'm like borrowing from the bank at 1.64%, and I can take it and invest in risk-free assets at 5.2. I'm just picking up free money here. I'm like, it's awesome. That mortgage, which was a liability, obviously, a year and a half ago, is all of a sudden an asset. But some of these banks on the other side of these mortgages are stuck in these things for maybe a prolonged period of time, and that's not good news for them. And then we look at the KRE, and it's sitting down near the December lows, not looking healthy at all. KB is starting to come off too. Obviously, KRE maybe had some of that SI in there, which didn't help it. But I just get into a situation looking at here and saying, these banks, with the higher interest rates and the inverted yield curve, maybe actually struggling here, and maybe it's going to struggle to hit the numbers next quarter.
And when you say the banks, like, why is higher rates a positive to banks? Part of it, all right, so, and why is the short-term pickup very positive? It's because the banks aren't paying us consumers the proper rate on our checking accounts, right? The banks could go earn 5% risk-free, and the checking account balance is you're getting paid zero. So, like, checking accounts cost you 5%. Like, it's really robbery of what they are not paying us the appropriate rate. I mean, this is something WisdomTree is trying to solve for in our app WisdomTree Prime, where we're going to build wallets with tokens that you could eventually spend from the tokens and earn what you really properly deserve in treasury. It's a big initiative. Right now it's just sort of waitlist mode on the wallet, but it's something we're building towards. But that's sort of the reason why. One of the things is banks have this low cost of financing and deposits. They're not paying people the proper rates of check accounts, but one of the interesting data points that we've talked about as a sign for inflation, but it comes back to bank lending, is the money supply is contracting. Like, this is one of the things we said the Fed should be more worried about, that money supply from M2 is contracted almost 2% after it exploded 40%. Well, what does that represent? It represents the fact that banks are making less loans, that there's less demand for new loans. And that's what the sort of lower M2 supply shift. So that is one of the headwinds for these banks in aggregate, is that, and you see that in the money supply contracting, that there's less demand for new loans.
Jeremy Schwartz, Chief Investment Officer over at WisdomTree. Give me something positive. Give us something.
Well, we got to be getting closer. As much as Powell says we're continuing going after it, we've got to be getting closer to the end of this cycle. Earnings are holding in. hey, you can get the 5% without taking a lot of risk. That's not exciting, but in treasuries, you could get 5%. So, at the short end, you're earning so much better on your cash than you had for the last decade. So that's a very big positive. And then it's like, well, where do you want to take risk? Where are you paid to take risk? High yield bonds yielding 8 to 9, depending on which basket you buy. For WisdomTree, WFHY is our high yield ETF that has some quality screens. I like that because you earn 8%. I think the S&P is priced for around 8% over the long run, which is sort of 5% real, 3% inflation, based on a little bit lower than 20 PE ratio. If you get 8% in high yield bonds that had half the volatility of stocks historically, that's a nice trade also. So, the sort of income back in fixed income is the big tagline for what the environment is. But hey, the economy is holding up, so earnings will be better than feared is the thing that's encouraging for the markets.
What about go ahead, Mitch. I'm sorry.
No worries. I'm going to jump in here. I did want to talk about we just talked about a little bit about the Fed, Jeremy. Of course, I talked to many economists before that we're all just stuck on 25 basis points from here on out. Do you really think that we could get that 50 basis point hike? And what could that do to the markets since everyone was already looking at like the 25 basis points?
Ask me at like 8:45 tomorrow, even though I'm going to be I'm traveling to Park City tonight to go skiing. So I unfortunately will be trying to have some fun. But tomorrow's a big day. The market certainly is saying that they raise the probability, and that itself is self-reinforcing because the Fed could say we're not going to shock the markets. But I would be careful from reading too hot of an economic situation. Yes, some of the data is coming that way, but there's other sort of real-time indicators. One of my friends, Peter Bookvar, pointed out that ZipRecruiter's earnings call, this is sort of one of these forward-looking job sites. They post jobs. They saw a surge in people looking for jobs and a dramatic drop in posting. So their January revenue was down 15% year over year. That's not a positive sign for the job market. And so you sort of start questioning the efficacy. You don't want to be these conspiracy people who say this data is just completely wrong. Although we're saying that on inflation, that the inflation data is completely wrong. Perhaps the jobs data is wrong. And, the Fed becomes, eventually they start seeing this show up and eventually it shows up. And so I still think there's a possibility, even though the market's now pricing 50, I'm biased towards saying weaker tomorrow, and then maybe it's 25. But let's
see what the numbers are. Before we let you go, I just being S&P centric here, I look at this mega cap tech and Apple, holding in there. These are the big components, of the index. You have just a broad outlook on mega cap tech. I mean, a lot of people are looking at the small caps.
Yes,
but for the S&P to go, where are you at on this, Jeremy?
I prefer small caps. I'm with the people who are saying small caps are a better buy. I like the discounts, maybe too much of a value investor, but I say 11 to 12 PEs on small caps at WisdomTree. We have dividend family, earnings family. All of them are 11 to 12 PEs. When the S&P's at 18 to 19, I think it's got a margin of safety built into it that big tech doesn't. I mean, the big tech P's are in the mid 20s, and that, it's just a higher hurdle rate that they have to live up to. And so earnings expectations are higher. You get 5% in treasuries versus a 4% earnings yield. I mean, you're upside down on that in big tech versus, hey, I get a 9% earnings yield in small caps. That's still a good cushion over treasuries. And that's where I would be.
How's the professor? Is he still pounding the table that
he's had to push back his thesis. I mean, he thought the Fed was going to pivot much quicker because we thought there would be a lot more weakness in the jobs reports. And unfortunately, the data hasn't come in. Unfortunately, all these questions about, to Powell, you really want unemployment to rise? No, we don't want unemployment to rise, but we think he's being too tight that it will rise. And so unfortunately, the data is not coming in to show they could pivot. So it leads him into making a bigger mistake. is I think part of
His
the.
thesis. He's sticking with it. Okay. Jeremy Schwartz, he's the chief investment officer at WisdomTree. You be safe out there on that ski trip, okay?
I'm gonna try. It's the first time skiing in a few years, so we're gonna try.
All
Have fun.
right.
Have
Thanks
fun,
again.
man. Later,
Thank-
Jeremy. Have a good one.
S&Ps. I mean, we're
Holding
buoyant
on.
here. We're up
Yep.
3 1/4 handles at 98 1/4. So some optimistic. Got all kinds of support to lean on from the lows from the last couple sessions, and then that also goes right back into the Friday Globex low. I think if you're looking for some, we kind of had a nervous market yesterday because Powell was testifying. But today I don't think he's saying anything. So I think if you get through 03 1/4, I know that's only 5-6 handles away. Not much up on the outside there. We'll see if people are peeling out, but that would be my key to a sustained rally here for Dennis to get his 400 level that he was talking about.
Not too far
Friday.
away. Hoping
No?
we can get back up there. And yeah, I'm in the full sell the rip camp here. Not so much buy the dip. Again, still thinking we're going to chop around a lot. The stuff we're talking about this morning, major media is not talking about it at all. We're early on this. But it's something to think about. So it's something like that doesn't make me, I'm not going to go jump on and buy any regional banks right now. I'm not going to, it's more of a word of caution to the value investor that looks at some of these regional banks and say it's trading 10, 12 times earnings. How can I go wrong? This is how you can go wrong. So they're just not as simple as like low PE buy.
Like that outlook, and looks like we have another guest in the background here. Joel, you want to bring him on? You want to announce him on here?
Is it Mr. Melvin?
Of course,
did you
he's
get Mr.
ready.
Melvin?
He's
Nice.
ready.
Yeah.
Look at that. All right,
Okay.
let's bring him on here. Tim Melvin, how we doing? Welcome
We're
to the
doing
show.
great. You guys, Joe, you caught me out walking the dog this morning with your email, and I came back in at like 8:52. I'm like, oh man, I hope I didn't miss it. So here we are.
Perfect.
And I hear Dennis talking about regional banks, and I think his comments were spot on. You got to be careful here.
Yeah. So Tim, tell us, and again, we got this situation here happening, and this is not, a typical regional bank. We're talking about SIVB because Silicon Valley, venture capital, lots of other stuff happening there. But what's concerning to me was looking, and just researching last night, and if their mortgage book is really tied up in long-term mortgages at lower rates, and obviously you got this inverted yield curve pressuring that, that's not a good recipe here. Do you think there's other regional banks that maybe have some ugly mortgage books right now?
We're not worried about the mortgage books. I'm not going to lose any sleep over the mortgage books.
Okay.
It's they may be a little bit lower rate, but that has a tendency to adjust. Dennis, they'll be putting on new paper. A lot of the smaller regionals are selling that paper. There's still a really active securitization market.
Okay.
The bigger concern right now, when we look at all these banks, is rates are going to go higher. That's a problem for the banks that reached too soon for yield. Okay. They came out when rates were close to zero and they said, oh my God, I got to get some yield in here. So they bought mortgage backs and they bought treasuries and they bought municipals at very low yields. Well, guess what happened when rates went from 0 to 4 3/4? They got killed. Now, thanks to the brilliant folks that set the accounting standards, anything that's held in your available for sale portfolio as a bank, you have to take that mark against earnings and book every quarter. Some of these guys really got stupid. And I'm sorry, if you're buying a 30-year bond when rates are at 0 and you're paying 2, you don't get to claim intelligence. That was stupid. Okay.
There you go.
So that's going to continue to be a problem for some banks. Most banks are just going to hold these things to maturity. They took 15% hits on their security book, 20%, and that's okay. There's some banks out there that lost half their book value. That's not okay. So look, Silvergate's gone because of mortgages. Securities. Everybody's like, oh, it was the crypto. No, it wasn't. Crypto was the what lit the fuse. They had to sell securities they bought because in the early couple years ago they were generating a ton of cash. They don't have the mortgage book or loan book to justify that, so they were buying securities to cover those holes in the balance sheet. They had to sell securities. Now, when you have the maturities and you take the mark and you hold them in maturity, you get the whole mark back. Okay. When you sell them, you take the mark and it's permanent. So they went from a temporary loss of capital to a permanent loss of capital when they sold. All their equity was gone. Had they not had to sell, they could have rode this out. Now, looking at SIVB, Silicon Valley Bank Corp,
Sure.
dumbest Tim trade ever. Bought this stock in the 90s, watched it triple, figured that was way too much for a bank and sold it. We're talking like 15 to 45.
Okay. Oh,
okay. Wow. You saw where that bank went.
Yeah,
We
370. Yeah.
Yeah. In the aftermath of COVID, we put it on just a little bit under 200. That worked out real well. Took some gains on that and put it out, as a public recommendation as well. Venture capital is getting ready to have the worst year it's had since 2008. Venture capital's a big part of Silicon Valley Bank Corp, SIVB. It's a big part of their business. They're going to take some marks. Fair value is right around 200. So if you get it 150 and you've got that big discount to fair value, then I think you start to get real interested in the stock. I think it's pre-market. I was looking at 195 this morning. That's still holding.
189, yeah.
189. Down around 150, you got to start getting interested in that. That is
Tim, I just one question for you. I got to hop here in a second.
Okay,
I'm not looking for individual, banks or names or anything, but you've always talked over the years about like how many are in like the buy zone. Like, and I know you're very disciplined and you've had the same strategy. And there's some times where you've come on and say, yeah, there's quite a few that are meeting my criteria. In this current environment, is the list a little bit depleted, or is it starting to get some a few banks in there?
There's two answers to that. Okay, one, larger regional banks. Okay, pretty depleted.
Okay,
small, tiny community banks, those trade by appointment.
Yep, we know
bill stocks. Okay, there's a lot of that list is growing.
Okay.
But we are talking now banks that trade 1,500, 2,000 shares a day. So
okay,
really
you can buy them. You just got to be patient.
Okay.
And I tell people, don't think of trading bank stocks. We're buying a bank here.
Okay. All right. I'm gonna hop. I'll let you guys finish up. Tim, I'm glad I caught you. The phone number I called wasn't any good, so I'll have to get a new phone from you.
I'll send that to you, Joe. Sorry about that.
Thank you, sir. Thanks for coming on such short notice. Tim Malvin completely gives you the bank information that you need. Thanks, Tim.
Good seeing you guys.
Thanks, Tim.
All right. Thank you, Tim. Thank you, Joel. Joel's getting out of here. Tim, appreciate you coming on and giving us some information. Let's wrap up here, Dennis.
What is so interesting about this rally and with the conversation that we just had about
let's
banks,
get to it,
is the banks are not rallying at all right now.
Yep.
I mean, Citigroup is still down. Bank of America is still down. They didn't even rally a sniff here. We just rallied 15 handles on the S&P, and the banks didn't rally at all.
Mm-hmm.
Bank of America is sitting at the lows of the session.
Even Morgan Stanley, that it was hanging on, right? This had that earnings gap.
Yeah.
I could see that earnings gap closing now, especially since there's no real strength in the banks, and this is coming right back down to 95. This is actually going to be on my radar here for live trading coming up. I'm going to keep this watch on Morgan Stanley, see if we close that gap. Goldman Sachs, will we go to the 340? JPM definitely on my radar today too. Bank of America has just been really kind of hit hard here. Wells Fargo, definitely not the areas that I'll be looking for strength. The only area that I've continued to see strength in, it's technology, right? I mean, technology has continued here. This is my sector outlook, and you guys can see how yesterday and the kind of like the day prior, we bought the dip, pulled back a little bit, could push a little bit higher in technology. What do you feel about some of these tech names, especially
some of the
semis?
tech names don't have any debt. So you've got to look at that too here. And I mean, we've been talking about this, in a rising interest rate environment. Eventually, some of these companies that really have a lot of debt are going to, have a lot higher interest payments going forward. Some of this debt's going to mature. They're going to have to refinance at higher rates, and that's going to hit their bottom line. I mean, there's a lot of tech companies that are debt free. So, I mean, I think if you're investing at this point in time, I think it's very important to look at the balance sheet. Look at what you're investing in. What obviously, you want to see growth, you want to see all that stuff, but you want to see what's the debt situation here? Because is there, a substantial amount of debt that's actually going to eventually impact the bottom line when they have to refinance? That's something to think about there. So it's not surprising, like this conversation we just had doesn't really apply to a lot of these bigger tech companies. A lot of these don't even have debt. But just as much as some of these banks are underwater, some of the really heavy cyclicals have a lot of debt too. So, if you get, prices actually starting to come down, and not that has happened much yet, but if you start to see it, and, the interest rate expenses start to go up, I mean, that's going to squeeze margins for some of these cyclicals too. So just think about all that stuff. I think right now, if I'm looking to invest, I want to be looking at companies with relatively low debt or no debt, and which is a lot of tech companies. So I think, there is a place for tech here still in the portfolio, but you got to, find the right ones, and, you just can't jump in blind here. And I still think overall, we're going to be in a choppy sideways market. But right now, banks are a no touch for me until I start figuring out, how, especially the regionals, maybe some of the majors, maybe in a little better situation. But I think some of these banks are value traps here.
Yeah, we'll keep watching. We'll see what happens. Yesterday, best trade on the day was a day trade I got on AMD. It's pushing strong. I don't have it right now, but we'll keep watching. This has really gotten strong since that Daniel Loeb pass active stake. So keep watch to see what happens there on AMD. It is pushing. We'll see what happens in some of these tech names. And
It's
you guys
been
can
such
keep
an interesting year, Mitch. I just want to stay on that point here because
definitely.
We had such a value outperforming growth year in 2022, and we are not seeing that in 2023.
No,
we've seen some of the oil stocks, the value oil stocks coming down. We've seen some of the consumer staples, which, some of them have lower P's coming down. And then we've seen growth stocks actually starting to show a bid. And I mean, turning. We talked about the 50% retracements in some of these. It's interesting, and not that Kathy's going to be right here at the end, but she can be right in the short term here. And I'm actually more inclined to buy tech companies that are growing here as opposed to buying the value names here with a lot of debt. So again, some value names are really good buy. But again, look at the balance sheet and look at that. But we're starting to see in this year that tech is starting to, Apple's point, and obviously holding up well.
Yeah,
Microsoft
holding up well. I can see 155 showing up.
I mean,
soon.
There's relative strength here. And Apple, yes, they have some debt, but they don't have a lot of debt relative. They could pay that off if they needed to. We know the only reason they borrowed was because money was really cheap. They borrowed because money was really cheap. They borrowed to do buybacks. So they can just stop a little bit of that if they need to. They have the money that it's not like, they're burdened with debt and they're in trouble here. So think about that when you're investing here. I think we're still going to be in a choppy environment, but you are seeing this sustained rally in companies that have a lot less debt as opposed to companies that do. And I think that, this interest rates continue to rise is a burden for some companies. And you got to consider that. Don't just look at the PE, look deeper.
Look deeper. That's especially what it is. It seems like this year is really going to be more of that stock pickers market versus just going all in on one area, right? We'll see what happens today to see if the technology can stay strong. Do the banks come down? Of course, like Dennis mentioned, we might be a little bit early on this story, but I do appreciate Dennis doing a little bit more of a deeper dive.
I think we're early.
So thank you, Dennis, for doing that deeper dive. I know that a lot of the time
I'm not trying to scare everyone that we're going to the next financial crisis, but we just got to be aware, that there is some
It's a yellow flag right now. It's not a red flag. It's a yellow flag. Pay attention to this because there could be some more worrying down the line.
Agree, Money Mitch.
All right. You have a great one, Dennis. Go do what you do best, man. Go get to your trading action. We'll see you a little bit later. You guys can keep up with everything Dennis Dick does. Triple D Trader on Twitter. Give him a nice follow. Smash up on those thumbs. I hope you guys enjoyed us getting a little bit deeper, bringing on some different guests. That's what pre-market prep's all about. I know sometimes people get focused that pre-market prep's a day trading show. No, necessarily it's a show to get you ready for the market. Sometimes we're going to talk a little bit more macro. Sometimes we'll be more in micro catalysts, focusing on one stock. But what we try to do for you guys is really just give you the transparency of our mind going into the market. Sometimes it's Dennis, Joel, myself, right? We try to give you guys some things to look at. Like always, you guys make your own investment decision. This isn't for financial advice, but for educational and informational purposes so that you guys can stay on top of your game and get to the market. Up next, we got live trading coming up next. Hope to see you guys over on live trading. Been killing it lately. Killed a trade on AMD yesterday. Have all but just one swing trade in the green today. ASO is slightly into the red there, but we got SEDG, FFM, X, American Airlines. Come find out how I'm doing on my swing trading. Of course, on Start Swing Trading, our swing trading show that starts from 3 p.m. to 4 p.m. Eastern. Probably the only one out there doing live swing trading. So I hope you guys enjoy that. Hit the thumbs up. And of course, you guys can always check out the closing print with Joel Alcon. Now to get you guys over to some live trading action. Let's see what I can roll up my sleeves today and see what the market has for us. Come find out what Zunaid, myself, and of course, Lord Ryan get into.